The CPI inflation report dropped on the same day that the FOMC, that the Fed had their press conference regarding rates. This is why I streamed for 7 hours. I went live for the entire day. So let us get into it, what this means for your portfolio, what plays do I have on the horizon due to this, and we're going to get into Jerome Powell's shocking confession about the jobs numbers potentially being overcooked. So let's get into it. Inflation supposedly slows in May with consumer prices up 3.3% from a year ago. So the anticipated rate of inflation was 3.4% year over year. We came in 0.1% better at 3.3%. And get this, month over month, we were unchanged. The consumer price index held flat through May. This was the first time since May 2020, since the pandemic, that the month-over-month numbers were unchanged. Now, because CPI was released the same day as FOMC, a lot of people thought that these good numbers were going to be reflected in Jerome Powell's statement on the afternoon after these CPI numbers came out, because CPI came out at 8:30 a.m. in the morning and the FOMC conference was at 2:30 p.m. in the afternoon. Not only did the Fed not cut rates as we expected, but the dot plot came out showing more hawkishness than ever, with 11 of the 19 Fed officials saying that the rate either needs to remain unchanged through the rest of the year or we should only have one cut. Only a handful of officials, 8 of the 19, actually projected that we have 2 cuts this year in November and December. Now, because of that, we saw yields tank. I'm going to get more into treasuries when we talk about our plays, but it's clear, at least off of the first reaction, that the S&P 500 and the NASDAQ really cared more about the good inflation numbers than they did about the fact that the Fed is actually going to maybe not even cut rates for the rest of the year. Now, you'll remember last week when we had the unemployment numbers, when the unemployment numbers were released, there was a big discrepancy between non-farm employment change, meaning the number of non-farm jobs that were added, and the unemployment rate. So the non-farm employment change was expected to come in at 182,000 jobs added. We came in almost 100,000 more than that at 272,000. But then the unemployment rate ticked up, and from the expectation of 3.9% to 4%. We are now in 4% unemployment range. So a lot of people were wondering, how could there be so many jobs added, but the unemployment rate go up? And there were a whole lot of theories trying to explain this discrepancy. Were most of the jobs that were added here part-time jobs that were then counted as full-time jobs? I'm sure if you guys tracked this stuff, you guys saw a whole host of theories as to why there was this discrepancy. But then Jerome Powell himself came out and said this about the jobs numbers.
We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and you know that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated.
There may be an argument that they may be a bit overstated, you think? And before we get into the plays, I want to talk about why there is this view that these numbers are cooked. Well, it's because the average American is still dealing with high prices. So TransUnion has a survey that measures Americans' worries about inflation. And these worries have hit their highest level since 2 years ago. More than 8 in 10 people, or 84%, said inflation was their top household finance concern in the second quarter, TransUnion researchers said Wednesday. Remember, this is the same day that the inflation report somehow came in cool. So the head of global research at TransUnion, Charlie Wise, said consumers have a difficult time differentiating between inflation prices. Inflation is a rate of change. Prices are an absolute. Yes, no shit. Prices are what we actually pay when we go to the store. I don't care about the rate of inflation change. I don't care what is the reported rate of inflation change. And besides, when we say that inflation is 3.3% year over year, that means that prices are up 3.3% from last year. That does not mean that inflation is going down, even if the number comes in less than expected. Even if the number was expected to be 3.4% and it came in at 3.3%, that does not mean that inflation is going down. That means the rate of inflation has gone down. But the rate of inflation means that prices are still going up from year to year basis, right? So, of course, the prices are absolute. That is what we pay. We don't care about the rate of inflation. And I found this another very surprising article here saying stocks are up 12% this year, even more now that we've created all-time highs. But nearly half of Americans think they're down. What is going on? And if you read the article here, it points to 72% said they believe the rate of inflation is increasing, even though these reports are telling us it is decreasing. In addition, the poll found 56% of respondents said the US is suffering through a recession. So what this points to is that the average American feels like the system is broken, feels like prices are still working against them, prices are not fair. Most Americans feel like we are already in a recession. And that is why, obviously, there's this idea that the stock market is the economy. And if you are, in the average American category and you feel like we are in a recession and prices are really starting to hamper your ability to live comfortably, you're not going to be invested in the stock market. So if you ask the average person, do you think stocks are up or down? Of course, they're going to say down because they cannot fathom that, hey, I'm paying this much for gas, I'm paying this much for rent, but yet stocks are up at all-time highs. How can that be? Anyway, I'm sure a lot of you are feeling that frustration too. But aside from the dot plot showing that most Fed members support none to one rate cut, Jerome Powell himself said that even though we had a good number today, that really doesn't mean nothing. We're going to keep rates unchanged, and we need much more data in order to cut rates. And until the Fed cuts rates, this is why I keep telling you guys, you want to find asymmetrical bets. You want to find good deals on mega caps. You want to buy corrections. You also want to take advantage of low-hanging fruit, such as Apple. Like I said before, when Apple hit the 165 support level that you see here, same one from October, we hit that in April. What did I tell you guys? I said Apple is the last mega cap to talk about AI. We had Amazon talking about AI, Google talk about AI, Meta talk about AI, right? We have all these companies, obviously NVIDIA leading the pack with AI, Microsoft talking about AI. The only one that was quiet about AI was Apple. However, as I mentioned to you months ago on this channel, that Apple was secretly swallowing up AI companies. It bought more than 30 AI companies last year, and it's only a matter of time before they present their AI offerings into their products and services that they are going to offer in the coming years, right? So we bought Apple at 165. Here it is. If you don't believe me, March 5th, 2024, I said my next buy on Apple is going to be at the 165 level, which was the support level from October. And you could see here as of today, we are up 22% on our Apple position as it crossed $200 for the first time ever. I'm now going to be selling calls on our Apple shares that are up and collecting income, making our shares work for us, collecting income on our Apple shares. So I'm going to give you a couple of more plays here based on the data that we have. But if you want to get all of my up-to-date plays, all of my option selling plays, all of my stock alerts, obviously the day trades, I went live for 7 hours today, made $12,000 on stream. We mostly traded gold, but I go live with the team every single day in the Discord. So if you want to join, click the link in the description, use the coupon code that you see there, and make sure you come and join us and trade live with me every day, as well as get my analysis on what I'm buying and what I see in the market. So aside from Apple, which no, I don't think there's an opportunity now. I think it's too late. What am I looking for? One thing that I'm looking for is I'm looking for a post-split drop on NVIDIA. We haven't seen that yet. However, we did see a post-split drop on Google, on Amazon. We did see a post-split drop on Tesla, etc. So I don't think that NVIDIA is any different. I think there is a lot of demand in NVIDIA once it did a 10-for-1 split, and it is now priced in the 3 digits instead of the 4 digits. But I'm waiting for a post-split correction, and then I'm going to be running the wheel strategy on NVIDIA, selling puts, getting a sign, then selling calls. Another thing that I have my eye on is Tesla. Now, Tesla has been coiling here very uncharacteristically for the last couple of months. We've been coiling here on Tesla in the same range, right? I said before that I'm interested in either buying a strangle because I think that in the next 2 months, Tesla will break out of this range, whether long or short. So you can buy a strangle in order to take advantage of that breakout, especially since IV is relatively low since we've been consolidating for so long. But if you do believe in Tesla as in terms of a bullish play, then obviously this is the time to buy 2-month or 3-month dated calls to give yourself enough cushion for that run up. Now, Tesla does tend to break out, does tend to love to break out in the summer, even during bear markets. 2023, this right here was June and beyond for Tesla. Go to 2022 during a bear market. June and July were still months where Tesla went up 30%. If you go to 2021, you'll see this happened in the summer for Tesla. So Tesla does like to see, because it does do announcements in the summer as well. And I think we are going to be getting a robo-taxi announcement in August, maybe something AI related as well. So I think that there could be a run up to that August event. And I would be comfortable buying, like I said, you can buy Strangle if you're undecided on Tesla's direction, right? But I do think it will obviously break out violently in one way or another within the next month or two. Or if you're bullish, I would say you could buy calls on Tesla that are 2 to 3 months out, anticipating a run up. I wouldn't go too far out of the money. I know you guys love to gamble sometimes and go so far out of the money. That is not my forte. I'd rather go near the money on Tesla calls if I do buy Tesla calls. Now, with regards to rates, I do think that the interest rate story is the Fed funds rate story is as bad as it's going to get. What do I mean by that? Like I said, the dot plot here shows that most Fed members are actually projecting that we get either one cut or no cuts, right? 11 of the 19 Fed members. So that is as bad of a story as it can get in my view, right? We went from 6 cuts to then 3 to then 2. Now most Fed members, the average cut projection is 1. And I think the market is digesting this very well. Like I said, you could see that the NASDAQ and the S&P 500, they are really running on the fact that we are going to be getting a soft landing. I'm not saying we are, but the market is running on the fact that we're going to be getting a soft landing and that we are seeing inflation numbers finally come down. Like I said, the first unchanged month over month since May 2020. So the market is rather enthusiastic about that. However, I do think that with that said, that the Fed funds rate story is pretty much as bad as it's going to get. If we get 0 cuts this year, I don't think the market will even care. Okay. I think the market is going to care about other things, such as if something in the system breaks because rates remain unchanged for a long time. And you can see here that the 10-year treasury, the 10-year yield, broke an extremely long trend line all year. And we came back to retest the trend line to fall thereafter. And it looks like we are in bearish market structure on the 10-year. So I do believe that on the 10-year futures, remember when rates go down, the 10-year futures go up, or the treasury prices themselves go up, whether 10-year or 2-year. So I do think that there is an opportunity here for a bull run in the 10-year futures. Now, if you don't want to trade futures, obviously you can trade ETFs. You can also buy the treasuries themselves, where I do think that in 2025, we will see double-digit returns on treasuries themselves. But I'm comfortable stacking up on TLT here. I said this when it dropped below 90, but I'm comfortable in this range on TLT. And I think that depending on what happens with other data, before the next before the next rate decision, I think that we could see a run-up, a short-term run-up in TMF, which is a 3x ETF tracking TLT, right? Now, I don't buy and hold this. I don't believe in buying and hold leverage ETFs. But I think that there will be a chance to place a short to midterm trade on TMF leading into the next rate decision, depending on how data drops. This, for me, I'm not going to be buying TMF right this second, but I will be buying it when I think it is the right time, and I will definitely be announcing that in the Discord. But I do think that treasuries and treasury ETFs here can be bought because, like I said, I think that the Fed funds futures picture is the worst that it's going to get. Now, it doesn't mean that we're not going to get a spike in yields again. It really depends what happens with the economy. But the Fed funds futures itself, I think that if we get no cuts this year, the market is not going to care. And lastly, with regards to mega caps and indices themselves, like I said before, the market has always given us a clue when to get out. And in 2008, I want you guys to remember that the first rate cut was September of 2007. What happened there? The market then tanked 60%. And if we go back to 2001, the crash in 2001, the first rate cut was in December of 2000, I believe. And that was right around here. And the market then dropped another 50%. So for me, once we get that first rate cut, that is when I will likely exit the market completely. And I really believe that, this thing follows a trend. This thing follows a path, and that the Fed is not going to cut rates until things start breaking and it is too late under the pressure of extremely high rates for a long time. I don't think this time is different. So that is why I keep saying that I'm a believer in buying stocks and looking for asymmetrical bets in, like for instance, buying Apple in preparation for their AI announcements. If we get a correction on Nvidia, initiating a bullish play on Nvidia, etc., because I do believe that you have to keep your money working in the market until you see signs that we are going to be facing a more disastrous climate. And for me, that sign is the first Fed rate cut. So do what you will, do what you want with that information. If you got anything out of this video, give it a big fat thumbs up. If you want all of my insights and my trades in real time, join us down below. Do not miss that opportunity to utilize that coupon. Join us down below. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.